Hey everyone. So let's talk about something we're all seeing right now: choppy, volatile, and just plain uncertain markets. How do you even begin to navigate this stuff? Well, the answer isn't about getting a crystal ball and predicting the future. No, it's about learning to read the market structure right here, right now. Let's dive in.
All right, before we get going, the usual housekeeping. Just a reminder that everything here is for education and commentary. We're trying to help you think better about markets, not give you financial advice. Every single market involves risk, so please always consult with a registered professional.
Now this quote, this is the whole game right here. When markets get chaotic and unpredictable, all the stories we tell ourselves, the narratives about why a stock should go up or down, they just fall apart. They become useless. The only thing that's left, the only thing you can rely on is the hard evidence on the chart, the structure. And that's exactly what we're going to focus on today.
So in conditions like these, what's the number one mistake traders make? They start hunting for the perfect trade. They're looking for that one setup that's a sure thing, the one thing that will make sense of all the noise. But honestly, looking for that kind of certainty, it's a total trap.
This right here is a massive mental shift you have to make. The market could not care less how confident you are in your idea. It just doesn't matter. What it does reward is verification. It rewards you for confirming what's actually happening. It's the difference between being a psychic and being a detective. We're here to be detectives.
Okay, so if we're not trying to predict the future, what are we supposed to do? Well, it's actually pretty simple. We just need to start asking better questions. And that simple shift takes you out of the fortune-telling business and into the world of having a disciplined, analytical process. Now pay close attention to this, because this is probably the most important takeaway of this entire explainer. On the left, you've got the wrong question. What's the perfect trade? Which, let's be real, doesn't exist. And on the right, you have three incredibly powerful diagnostic questions. Where is structure broken? That tells you where the old trend died. Where is it stabilizing? That points to where a new base might be forming. And my favorite, where is the invalidation? That's your escape hatch. It's simply asking, at what exact point do I admit I'm wrong and get out?
All right, enough theory. Let's get our hands dirty. We're going to put on our lab coats now and act like market clinicians. We're going to look at three different charts, read their vitals, and you're going to see how all three of them, despite being different markets, are telling us the exact same story.
First patient on the table, the GIF Nifty 50 Index Futures. Let's pull up its chart, its clinical notes if you will, and see what the health of this trend really looks like.
So, what are the vitals telling us? First, price is below its short-term moving average, the EMA. That's a clear sign of weakness. The RSI is low, which tells us momentum is bearish. But here's the kicker. Look at the ADX. It's high. That tells you this downtrend is strong. It has real force behind it, and fighting that is a bad idea. And finally, the MACD is negative, just confirming what everything else is screaming: the pressure is down. So what's the diagnosis? The key here, and I'll say it again, is that we are not predicting it will go down further. We are simply observing that the current structure is damaged. So, any little pop or rally that we see, we have to treat it with suspicion. It's more likely a test to see if sellers are still around, not the beginning of a real trend reversal. At least not until these vitals start to improve.
All right, our next patient is MCX Gold. Now, this is a chart of a market that has just been through a major shock, a major trauma to its system. And right now, it's just trying to find its footing.
See that term on the chart? Massive dislocation? That's really important. All it means is that the price has been stretched way far away from its average, from its comfort zone. Think of it like a rubber band pulled way too tight. When you combine that with a super high ADX, which tells us the move was incredibly powerful, what do you get? You get chaos. You get noisy, choppy, unpredictable price action.
And this brings us to the real lesson from this chart. In a dislocated market like this, trying to predict the next big move is a loser's game. It just is. The only professional edge you have, the only way to survive, is by obsessing over your position size and containing your risk. That's it. That's the whole game.
And for our final case study, let's look at MCX Silver. I want you to think of this chart as the most stressed out patient in the entire emergency room. All the alarms are going off. The risk of sharp, sudden, unpredictable moves here is at its absolute highest. I mean, just look at these readings. They are extreme. An ADX up near 68 is exceptionally high. That means this trend has incredible force.
The RSI is deeply oversold way down at 22. Now here is the classic trap. A novice sees oversold and their brain just screams, "Buy! It's cheap!" But a professional sees oversold and thinks, "Whoa, volatility risk is through the roof." Bounces from these levels are often violent, unreliable traps.
So we've now examined all three patients, Nifty, Gold, and Silver. What's the common diagnosis? Well, in all three cases, the trend is damaged and the momentum is clearly bearish. That oversold condition is a warning sign for volatility, not a guarantee of a bounce. And that high trend strength, that high ADX, is telling you that if you get caught on the wrong side of this move, it is going to be incredibly painful.
And all of this brings us to the most important conclusion we can make. The real goal is not to get better at predicting. The goal is to build a repeatable, audible process that keeps you safe and forces you to focus on what the market is actually doing, not what you think it should be doing.
I absolutely love this quote. Trade ideas are cheap. Risk control is expensive. Think about that for a second. Anyone can have an opinion. Anyone can have a trade idea. They're a dime a dozen. But having a disciplined process for controlling your risk, that's the skill that has real value. That is what's actually expensive. So make sure you're paying for the right thing with your time and energy.
So to make all this super practical, let's finish up with an actionable tool you can start using right away. Here is a simple 5-point checklist to run through before you even think about placing a trade in these kinds of conditions. It's just 5 simple questions. Number 1, liquidity. Is there enough volume to get in and out easily? 2, structure. Where is the price relative to key zones, like that EMA we talked about? 3, momentum. Is the RSI still weak, or is it showing any signs of stabilizing? 4, invalidation. Where is my idea proven flat out wrong? And number 5, maybe the most important, risk. Is my risk per trade absolutely capped at a level I can tolerate? If you can't clearly answer all 5 of these questions, you're not trading an opportunity, you're acting on an impulse.
So let's end on this final thought, because it just wraps everything up so perfectly. Your charts are like a patient's clinical notes. If the vitals come back and they all say unstable, the correct treatment is discipline and careful observation. The correct treatment is risk management. It is not drama. It's not high-stakes action. So think like a clinician, not a gambler. That's our explainer for today. Stay disciplined out there.